Strongman Personal Finance. So Meat Thruster just posted an interesting video. 10 steps to explode. To explode your wealth during the Trump recession. So we're going to have a casual video. We're going to react to it. We're going to make fun of me, Kevin, as always. And we're going to have a beautiful, delicious, wonderful Saturday. So let's go ahead and see what old Meat Thrust Kevin has to say. Here he is. Hey, guys. Wow. RuneScape shirt.
I'm Meat Kevin. In this video, we're going to talk about 10 things to protect your money, whether or not we're going into an economic downturn. Let's get started. The very first thing that you need to do is think about accessing capital while it's still possible to do this. This obviously won't apply to everyone, but about 2/3 of you are homeowners. Now is an interesting time, even when rates are high in the near term, to potentially look into a refinance. But I want you to do something special.
Guys, I have a 2.89% interest rate mortgage. My mortgage payment, not including taxes and insurance, is $1,056. $1,056. So apparently, I need to refinance my mortgage at higher interest rates? I wonder why Kevin wants me to do that.
I want you to take negative points. Now, this video isn't going to be about the real estate market, but let's give you a quick synopsis. In certain overbuilt markets, especially after the COVID boom, we're likely going to continue to see prices decline in some markets. For example, if you look at Austin, Texas, the last 3 years, year over year, have had negative prices year after year. Well, that's because we had a COVID bubble, overbuild, oversupply, and all of a sudden the rush of people moving there slowed because others weren't squeezed out of areas like California.
We had a virus bubble? Oh, wasn't that the time when you were going all in massive clown stocks? Interesting.
Under the extremeness of some of the lockdowns California faced. This isn't designed to be political either. It's just simply to say the fact. The Austin real estate market has been down year over year for the last 3 years in a row. What you want to do, even if rates are high, is consider refinancing to tap some of the equity if you have equity in your home. So for example, if your home value's ballooned up, even if you have a lower interest rate locked in, let's say if you have a $200,000 loan locked in over here, and now your home is, let's say it was worth $800,000, whenever you got your loan, it was worth less. And now it's come down a little bit. Let's say now it's worth $700,000 or whatever it is, 620, whatever. It could make sense to refinance. Even though you're losing that lower rate, you could potentially access some more capital. This is going to become very important for when we get into the budget.
So I bought my home for $254,000, and technically it's worth $330 or something like that. And my loan balance is like $230. So I have $100,000 of equity. And instead of continuing to pay down my mortgage and locking in a fixed rate mortgage for 30 years, under which my payment will never change, the $1,056 will be $1,056 until I pay off this mortgage. And I'm going to keep getting raises and making more money. And there's going to be inflation. So the actual real value, the real price of my mortgage over time is going to go down as a percentage of my income. But no, you should refinance. I should take out $100,000 of equity at 6-7%. What should I buy, Kevin? Yield Max? No. If you have a low rate mortgage, it is a gift from God. This low rate mortgage is the reason I can do lots of things, okay, and potentially quit my job. It's a gift because my payment is super low and it's never going to change except for, principal and, taxes and insurance. That'll go up a little bit. Why would you get rid of that? So you can reset your mortgage at a higher interest rate? No. What a moron. This is already awful. We're 2 minutes in.
By the dip phase. Because let's say you have now $400,000 of equity that you could access. You pay off your old loan. You obviously have to make sure you can afford the 30-year mortgage payment that you're doing on this. But what you've done is you've freed up the difference. You now have access to $200,000 in more capital. That's really important that you don't go below that money on like an RV or something crazy. Instead, be ready, be prepared to buy the dip, because that's what we're going to talk about in a moment as well. And those could be business opportunities, they could be stocks, it could be real estate, wherever stress shows itself. And as Buffett always says, wherever blood ends up on the streets, that's the time to get greedy, right?
Oh, yeah, that's right. It's always about buying the dip, because in Meet Kevin's little brain, which is why he has 2 million subscribers, stocks go down, Buy the dip, vertical line. That's not always how it freaking works, okay? Sometimes stocks go down for a long time. So you're going to borrow money and potentially have a couple years of a bear market. Anything's possible. You don't believe me? Well, you do whatever you want, okay? Anything's possible. You're going to borrow money. You're going to reset your mortgage. New York. And you're going to buy the dip. Oh my God. What a clown world we live in. But I'm the moron, guys, okay?
But you need access to capital to actually do anything. So what I like to say is consider using that piggy bank of your home or of your rental real estate or whatever. Just
if you want to time the market, go to cash. Buy a treasury, short-term treasury ETF. If that's what you want to do. I'm not doing that. But I'm saying, if you want to time the market, just go to cash. Why do you have to reset your loan that you got at a super low interest rate? Why would you do that? Go to cash or dollar cost average over your working life in a tax advantage account from your earnings, your paycheck. You have capital every paycheck, and you're going to average in. Why do you have to sell or buy or freaking take more money out to do buying the dip? If you're DCAing, you're buying the dip. And you're not paying interest. You're not resetting your mortgage.
To have access to capital. Now, again, don't blow that money. It's very dangerous to utilize your real estate equity, because oftentimes what people do is they'll pay off credit card debt and they'll get right back into credit card debt. That's a big mistake. So you want to be careful with what you do with this. This needs to be strategic. But this video is for adults. So what's also important is that you take those negative points, in my opinion. This is not personalized financial advice for you. This is broad advice for you to consider. When you talk to your mortgage loan originator, your lender, okay, in English, your lender, when you talk to them, I want them to give you negative points as an option for you to consider. I would like negative points, and ask for a menu. So ask for a menu that gives you negative 0.5, negative 1, negative 1.5, negative 2, and then do negative 3. Okay, so give you a menu.
Okay, from my recollection, buying points is like you're basically prepaying interest up front so that you lower the rate that they give you. I've never heard of negative point. What is this crap? Negative points. This doesn't sound good, because with actual points, you're prepaying the interest. Negative points, what are you borrowing more? What the heck's going on here? Just borrow money, bro. Interest rates are high, bro. Borrow money.
All right. Why would you do negative points? First, and what does this even mean? If the economy enters a downturn, we would anticipate that over time, interest rates are going to plummet. We can't guarantee this. But if there's a downturn and you want to use that potential capital on an opportunity, interest rates are likely to plummet. When interest rates plummet, the goal would be to refinance this debt that you took on, that $400,000 lower. No guarantees, obviously, if the property value.
What if you lose your job? Did you think about that? And now you've reset your mortgage at a higher rate.
Things go down. That could be a risk. So you want to be comfortable paying that payment. What negative points allow you to do is lower your closing costs now. So let's say you have closing costs of your refinance to get that $400,000 of $8,000 now. What some people will do is they'll do what's called a rate buy down. And they're like, look, it's going to cost me $8,000 to refinance, and I'm going to get a rate of, let's say, 6.5%. So some people are like, oh, that's so high. So they'll actually choose to pay $12,000, and they'll take an interest rate of, let's say, 5.9%. So now they feel like they got a better deal, but they spend an extra $4,000.
Yeah, I didn't do points on mine. I mean, it was 2.89%, so whatever. But yeah, he's basically correct. You pay more up front, and you get a lower rate. You're prepaying the interest.
Okay, the break even on that, at minimum, is going to be about 7.5 years. Realistically, the break even on this difference over here is probably going to be closer to 10 to 12 years. So that extra investment you're making for the savings and the monthly payment, it's going to take quite a while to break even.
I'd rather put the 4K in VT.
Not always. You can do the math yourself. That's why I say get a menu and do the math based on what you get. But here's what I like to do. I actually like to get negative points. So what I say is I don't want to pay $8,000. I actually want you to give me $8,000 and cover those closing costs. Give me a higher interest rate. So I might go in and say, give me a 7.4, and I want my closing costs to be 0. In other words, they gave me -2 points to cover my closing costs, right?
Oh, I see what negative points are. So you're going to get a higher interest rate. Genius. but hopefully rates come down, bro, because they might, oh, maybe. Is this real? This is such easy content. Thank God for these people. I love YouTube. I have so much fun doing this. This is a hobby that pays me. It's beautiful.
That might be the -2 option over here. Now all of a sudden I have more access to capital. Yes, I have a shorter term higher rate, but if the economy does end up falling, which is when I would use and deploy that capital anyway, I should be able to refinance. Again, predicated on home values and you having a job to do that.
Should, would, could. Reset, pay off your mortgage. You have a low rate mortgage. Oh, refinance it at a higher rate. Oh my God. What a freaking genius idea. Does anybody else see how stupid this is? No, seriously. Am I the clown? Am I dumb? I guess I am. I don't have 2 million subscribers.
So as with any strategy, there is risk and you have to go in knowing this. Now, another strategy that people like to take advantage of in these environments, and again, there are upsides and downsides with everything, but I like home equity lines of credit. So let's say you're in this situation where you own a home and you have a 2.9% interest rate on your $200,000 loan, and you're like, Kevin, I don't want to get rid of that loan. I don't want to refinance that at higher. Well, okay, that's smart. That's logical. So what you do is, let's say you have a $200,000 loan, and let's say the property is worth $800,000 in value. So you have all this untapped equity right here. So what you want to do is you want to hop in with a home equity line of credit for, let's say, up to 620, that'd be 80%. Maybe you can get up to 90%. Go to a local credit union for these, by the way. Usually the bigger banks like the Big Four, Chase, Bank of America, they're not going to have good options for this. Go to the local credit unions. So whatever county you're in, that county credit union, type that into Google. You'll get plenty of options. Ask them what their HELOC programs are.
Kevin does Clown County HELOCs.
Often even waive your first year application fee. Sometimes even they'll waive your appraisal fee. Okay, so you have the difference of 80% of that. So let's say 620. You have the difference of this and this available. You could get $420,000. Oh, that's perfect. $420,000 potential line of credit on this property. Now you might be saying to yourself, but Kevin, interest rates on this line of credit, that's insane. I'm going to pay 10% in interest on this credit line. That's insane. No, you're not. Not going to use it. So take the equity line of credit, establish the credit. So money tool number 2 is establish the line of credit. Okay, number 1 was negative points and establishing credit that way. Number 2 is get a HELOC. A home equity line of credit charges you no interest.
Okay, so reset your mortgage at a much higher rate and then have HELOC on standby at 10% interest. Genius! Why did I think of this? You can't just dollar cost average into an index fund and avoid high interest rate debt. No, you can't do that. You got to time the market, bro.
Interest until you actually write the check and use it. Imagine that a HELOC is just like opening or applying for a credit card. It doesn't mean you're paying 10% on the $420,000 or 22% of your credit card just because you open the credit card. You haven't spent anything yet. Okay, well, when are you going to spend something? You're going to spend when it makes sense to spend. When there's a great foreclosure that you can get a great deal on and acquire or buy, a great opportunity in business.
Where did he go?
To expand or whatever. You want a home equity line of credit to give you access to capital when you need it the most. Now, there are risks with this. Obviously, the rates are higher. Again, the economy goes into a downturn. These are variable. So you see what the terms of these are. They're usually a 10-year term, and then they go into a 20-year fix thereafter. So they're variable for 10 years. You could draw on it, you could pay it down, draw on it, pay it down. It's like a credit card.
Oh, variable debt, even better. Ask Andre Jeek about that.
Card. After 10 years, that goes away, it locks, and you repay it back over 20 years, fixed, fully amortized at that point. If you don't know what some of these things mean, sorry, the video might just be that next level at the moment, but we got to talk about next level finance.
If you don't know what that means, buy my course, bro.
Ask GPT about the little in-between things. So the HELOCs give you a tool, but there are risks associated with them. Mostly in that in 2008, credit lines were starting to get frozen. They would issue credit line freezes, and that's because the banks would go risk off. This is another reason why you want to start considering establishing credit now, establishing loans now, because credit is still available right now. Sometimes in a recession, credit becomes unavailable. Banks are unwilling to lend, and so they freeze lines. So once you start hearing rumors about this happening, or you start seeing some banks do it, usually what people do is they'll take that 420 or whatever their available credit is, they'll move it into a savings account. They'll bite the bullet a little bit on the interest, but they'll realize I now have access to that capital should I need it as a rainy day fund, basically.
Guys, take a HELOC at 10% and put it in a savings account paying 3%. Genius!
Okay, good. So that's number 2. Now, number 3 is also a double-edged sword. You have to be careful about this one in terms of how you do it. Well, as far as when it comes to business, but that's okay. So we'll separate these. You know what? We'll do number 3 personal, and then we'll do number 4 business. That's how we'll do it. So the personal one is a lot easier. And this one, we're not going to spend a lot of time on because it should be very basic. Okay? So delay. Number 3 is just delay. Do you really need a bathroom remodel right now? Do you really need a new roof right now? Can you patch the roof? Do you really need a new car right now? Can you make yours work for a little while longer? Do you really need a new washing machine right now? Can you fix it?
Do I really need Kevin's course? Oh, yes, I do.
Personally dismantled washing machines and dryers, and multiple times with a $25 part, fixed my $1,000 washing machine and prevented having to buy a new one. They take time, but they're kind of like weekend warrior projects anyway. I find them kind of fun. So I'm a big fan of delaying capital expenditures for as long as you can in more uncertain times, so that way you can build up cash reserves. That's very important. So a big fan of this. All right, that one's more obvious.
Yes, you should do that. If you think there's a recession coming, start building up cash reserves, not a freaking line of credit or refinancing your mortgage. That was the only logical thing he said so far.
Number 4 version is the business version of this. Now, this is more challenging because the easiest way to explain this one is through an analogy or a little story. I don't know if it's true or not, but it's just it's very functional. It'll really explain this one well. College-educated son goes to his father and says, "Father, we're going into a recession." And the father owns a knick-knack store on, let's say, Route 66 or whatever. And they have a sign, a giant billboard on the side of the highway. So, here's the highway, and they've got a giant billboard over here. We'll call it some store. We'll call it Nick's Knickknacks. Okay, cool. And it's that way, 2 miles is what the sign says there, bigger sign. All right, cool. So
thank you for all these details. I wouldn't be able to understand your example without this, Kevin.
College educated says, Father, we're going into a recession. We need to be careful. Like we should cut spending at the business. The business is over here. This is where Nick sells his knickknacks. Father says, "Oh my gosh, son, like all these reports, you're right. Like we should cut our spending. My goodness, you know what costs us a lot of money every month? That damn billboard. Let's cut the expense on this, and let's get ready for a potential recession." And all of a sudden, people don't know about Nick's Knickknacks anymore. And oh my gosh, my sales are plummeting. What is going on? Says Nick. Nick is very sad. My goodness, son, you were right. A recession is coming. Meanwhile, the billboard's empty. Nobody knows about a store, right? So on the business side, there's a complexity when it comes to cutting off the hand that feeds you, so to speak. So you have to be very careful. There's a lot of nuance that goes into the business side. But there are often things that, on a macro basis could be considered for delay or cuts. Usually what businesses do is they will delay risky capital expenditures, right? So let's take my real estate company for a moment. House hack, it's a real estate company.
Delay risky capital expenditures, but make sure, which it's not technically a capital expenditure, refinance your home, bro.
If you're an accredited investor, you can invest in it. This isn't a solicitation for it. And if you're not accredited, we have a non-accredited round coming soon. We're advertising bonds at 5%, and they convert into stock if the value of the company goes up. Blah, blah.
Oh yeah, delay risky expenditures, but buy my bonds of my opaque real estate company when we could potentially be going into a recession. And he even talked about home prices going down. But buy my flipping rental property business, bro. You get 5% interest, bro, even though you probably get roughly the same after tax with treasuries. Yeah, it sounds like a good investment. If it goes up, then I get it. It's a call option.
More details on that, different video, different topic. This isn't the place for it. But what we've done is, we've realized we have many options to rapidly expand the business in potentially slightly more risk-on moves. And for us, like for example, certain types of lending, real estate related, or fintech style lending in places where it doesn't exist in the real estate market based on equity in homes beyond what's available with traditional lenders. Going into a recession, that last portion of equity is the most uncertain in a property, and that is the greatest risk. So it might make more sense to delay risky allocations of capital like that. In addition, businesses usually will cut extraneous staff. Again, you don't want to cut the hand that feeds you, but extraneous staff where projects can be handled inside that are great enough to handle.
Is Kevin's course an extraneous expenditure? Think about that, ladies and gentlemen.
The progression of the business. But extraneous staff for potentially those expansionary projects, or hey, you might be useful one day, those are the first sets of staff to unfortunately get laid off. The earlier businesses do this, the more capital those businesses preserve, the more insulated they are going into a potential risk-on environment, and the more at a more opportune time they are able to deploy into that riskier move, which could be a big growth move for the company. Like, oh, maybe Nick Snicknack is like, you know what, we're going to invest into making this an electronic billboard, right? So let's say it was a regular textual sort of paper or cardboard billboard, if you will.
All right, this one's long-winded and boring. We're going to go on to the next one, the credit freeze. What's this?
There's a downturn in the economy, and then all of a sudden you lose your job, you're trying to get a new job, and they run your credit for your job, and your credit score is 400 because somebody stole your identity, and oopsie doopsies, now you don't get the job, or you can't get the loan, or you can't start your business at the most opportune time to do it because somebody hacked your identity. Everybody has your social security number and date of birth already. They're on the black market, they're available. You're just waiting for that scumbag to go into Macy's, open a credit card using a fake driver's license with their picture on it and your name and date of birth on it. And then they type in your social security number into the little pin pad, and boom, they steal your credit, racking up thousands of dollars of expenses at Macy's or wherever, and you don't even know about it. That's how easy it is to steal your credit. I want you to know that this is free, okay? You do not need to, you can, but there are plenty of companies that offer these credit lock features, and you have to be careful. There's a lot of branding around this. They try to sell you $30 monitoring services. A lot of these monitoring services are really just insurance. And they say, if your credit gets ruined, we'll help you pay out some money to you and try to get back on your feet. Good luck. It takes forever to get the claims done and all this. It's better when that scumbag goes into Macy's and steals your credit. I don't really want to deal with monitoring where somebody's going, your credit was just stolen. Thanks, bro. And I don't really want to deal with an insurance company going, hey, I got robbed here. Insurance, will you pay out on this? Well, on section 72 of our terms and conditions. And I just don't want to deal with that headache. I'd rather some scumbag go into Macy's and they try to put my credit number in, my name or their name, my date of birth or whatever, and social number. And Macy's runs my credit and it comes back 000. Okay? My credit comes back 000. They're not going to issue me credit at Macy's. And that's exactly what a credit freeze does. Now, these are now by law mandated to be free. So they are free credit freezes. And I'll just use these as bullet points now. What you're going to Google.
All right, that's boring. Let's get on. Oh, we got crypto and others. Here's where I think the good stuff's going to happen.
Well, companies, profitable companies, great companies, bad companies, and everything in between. Everything goes up. Problem is, what happens when it comes down? And so you really want to de-risk. Something to remember is cryptocurrencies, for example, and this isn't a bash on cryptocurrencies, it's just a fact, have not been through what I would consider a real recession. In 2020, we had a lot of pain, but we got bailed out. We had a 30-day basically recession, and it was basically V-shaped recovery, right? This is the most money printing we've ever seen in the history of money printing. It was ridiculous. There'll be a lot of hesitance to this today, which actually could potentially draw out a recession. But cryptocurrencies haven't been around. They were born out of the 2008 financial crisis. They haven't been around long enough to prove that they could stay and survive through a recession. There's a lot of risk here, mostly because money evaporates. It's not like when the price of Bitcoin goes from $100,000 to $80,000, somebody made that $20,000. Literally just evaporated into thin air. Just like it was created out of thin air, it disappears in thin air. And that creates a lot of risk for you, depending on how much of your portfolio is exposed to assets that just haven't been tested.
Never forget, Meet Kevin shilled FTX and pumped a bunch of cryptocurrencies. But guys, he deleted his old video, so now we don't know about it anymore. But he might be giving good advice here. He might be telling us to sell our crypto, of which I have $0 invested in.
During a recession. So, this is not anti-blockchain. I'm a big fan of blockchain and the goal of a decentralized common international currency. But it comes with severe risk. So as bluntly as we could put it in a non-financial advice way, de-risking is going to include crypto, small caps, honestly, even large caps, and even to a lesser extent, right? So I'll just put lesser because really everything people.
Okay, so I get, yes, you should sell crypto's garbage. Get rid of it. Yeah, you might have to pay tax if you have gains. So freaking what? It's worthless garbage. Now he's telling you to sell stock? Okay, it's okay to take out HELOCs and reset your freaking mortgage, but now you got to sell your portfolio too? Why do you have to sell your portfolio? It's a long-term investment. But the market's going to crash, so I need to take a loan and reset my mortgage, but I also need to sell my large cap stocks. No, just freaking hold them. This is not rocket science, people.
Flow money out of the indices. Large caps get affected heavily. But even recession, recession beneficiaries. But this is where there are opportunities. So an example of a recession, beneficiary, in my opinion, would be something like a Rocket Mortgage. Brilliant move to acquire. Redfin, by the way, different topic for a different video. But a recession beneficiary is a company that might actually do very well as a result of a recession. I personally think my version of this is my own company, House Hack.
Where is he going?
Because we're, without any bank debt, we're primed to take advantage of low interest rates and really good deals in real estate. But a company like Rocket Mortgage with a lot of high interest rate mortgages on their books, on their balance sheet, I think, or even other mortgage companies, it doesn't matter to me, it could be any company. These companies will benefit from rates coming down, from a surge in refinancing, in my opinion. Yes, there will be job loss.
Okay, so sell VT, sell crypto, and buy Rocket Mortgage. Wow. What a freaking genius.
Even if we go to 20% unemployment, that's 30 million people unemployed. 30 million minus, about 160 workforce, you have 130 million people employed. Usually the argument people make against mortgage companies is, but if unemployment's high, who's going to be able to refinance? Okay, well, if unemployment's high, the other 80% of people who are still employed can refinance. So yes, when rates come down, mortgage beneficiaries are, mortgage companies are beneficiaries. The downside is you can still go down in value before you get to the market realizing that, and you get that upside. Like, I kind of think about it like, all right, quick analogy. When let's say you're, sorry, I'm a pilot, so the jet references and plane references.
God, he makes these videos so freaking long. Okay. What's this? Margin?
Very dangerous. Realize that in real estate, home equity line of credit, a 30-year fixed rate mortgage or whatever, you don't have the risk of a margin call. Whereas with more volatile markets and margin debt, you have the absolute risk of having your portfolio liquidated at the worst.
Is that true? They can't suddenly reduce your line of credit? But yes, you shouldn't buy margin. Okay, let's do the last bit here, and we're gonna wrap this up. We're gonna time the bottom. Okay, we're gonna predict the bottom of the recession, just like me. Kevin was good at predicting the top, and then he bussied out and got rid of his freaking PP ETF. Now we're gonna time the bottom.
About how to increase the qualifications that you have. You're just going to have to work more. It sucks, but it's the most critical time to work harder and never give up. Do not give up. Good. Next, time. We have no idea how long this is going to take. If there is an economic downturn, maybe Trump could issue stimulus checks tomorrow and cancel all tariffs, and the market could go straight up. We have no idea what's going to happen in the future. But if we are going to go into a downturn, it's worth noting that we have not had a very long downturn, extended downturn in 2008. The 2008 downturn was maybe 15 months in total, depending on where you measure it from. Some people like to measure it from January of 2008 to March of 2009 is how some people measure it. Some people say that the true pain was actually only August to March, which if you look at that, this was actually a relatively short financial crisis. That's, 4 months plus 3, that's about a 7-month financial crisis. That
was one of the most devastating crises we've ever freaking had. Okay. But that happened in the past. We had a depression too that lasted a lot longer. And that also speaks nothing about what could potentially happen. Okay? You can't look back and say, recessions last on average 12 months. So I'm going to sell at the start of the recession and I'm going to buy the exact bottom 12 months later. It's not how it freaking works. Okay? Stop looking at past performance, you freaking brain dead clowns.
An extended drawdown, like something you've had coming out of the Great Depression, where you have lost 15 years of time, or potentially more recent, the 2001 dot-com bubble, which technically was 2001 to 2003. So it was about a 2.5 year, 2.5 years. Most people agree it was about 2.5 years.
But hey, if it's 2.5 years of a downturn, at least you reset your mortgage and, took a HELOC. Wow.
If you invested during some of these peak levels, you didn't actually see a return of your money, not on your money, of your money for about 15 years. So that's a very long time. It's a lost generation, really, if you think about it. And so I want you to think of your staying power in the face of time constraints. Time. I don't think we're going to see a 2020 whenever that next time hits. 2020 kind of sort of recovery. So
You know how you have staying power? You keep your low fixed rate mortgage. You don't take a massive HELOC and you put money in cash or short-term treasuries. And you save cash. That's how you weather the storm. And you develop multiple sources of income. So you're not reliant on one job. The last thing you want to do is follow his garbage advice and freaking take out a bunch of debt or have access to a bunch of debt so you can buy the debt. Save cash if you're worried. If you're really worried, maybe you can trim some of your miscellaneous expenses and put it into cash. Long-term investments, keep it in the stock market. But having cash will serve you well if you're worried about a recession. That's all you freaking need. Why do we have to make this complicated?
Recognize time is a big requirement here, which is challenging because we generally expect things to happen much more quickly, and I'm a victim of that myself. Okay, so now when is the time to actually buy the dip? Well, the technical bottoms in recessions generally occur about 3 to 6 months before the end of the recession.
There you go. And he knows when the recession's going to bottom. Okay, look at that past performance. Look at the data, bro. It's that easy. No, you don't know when the recession's going to end. Because the next recession can be the most brutal thing we've ever experienced in U.S. history. I'm not saying it will be, but it could. But if you look at the historical data, 6 months after vertical line goes down, then you buy the dip, and then the vertical line's right after that, and then that's what you should do. So take your HELOC, and then buy the dip at this exact moment, and then you'll make $1 trillion. Or maybe you'll get your cheeks clapped. Consider the risks.
All right. So how do we understand that? Well, the end of recession is usually, let's say it's here. Okay, this is the actual end. I'll just label this. Okay, end of recession. That's when it's actually over. Typically, the stock market hits its lowest point and starts recovering, sort of a V-shaped recovery, if we will. And usually they go higher after the recessions, right? So let's assume we came from there. So there you go. Okay. If the end of recession marker is here, the stock, it's very difficult to time, but the bottom of the market is usually here. And the lag between this point and this point is generally about 3 to 6 months. And that's because the lowest point in the stock market is usually going to be at the time of most fear and panic.
Okay, so just know when the end of the recession is going to happen and then backdate it 3 to 6 months and then go all in at that exact point. All you got to do is just know when the end of the recession is. And then you're going to have a V-shaped vertical line because it's U.S. stocks, bro. It's that easy.
Generally not when the recession's over, because the recession's over when you're already in recovery. When you're coming out of that turn, right? So the bottom will come before. And one way that I think you can measure this, the bottom, is you could use this ticker. This is no guarantee, right? But use this ticker, TLT. It is a bond, a ETF, and the maturity of these is about 25 years, U.S. Treasuries. None of that matters. True recession fear pricing. I'm going to give you a schedule. No guarantees of this. But I would say that $100 on TLT, it's like 90 now, is recession fear in. Okay, recession fear priced in. Okay, then I would argue that 120 is probably recession pricing. So TLT goes up when the economy is.
Okay, look, TLT is long-term federal debt, and it is highly volatile and highly sensitive to interest rate risk. Go look at the chart, and the past performance matters as a lesson of what happens when rates change. TLT got wrecked. It's highly volatile. It can go down a lot when rates go up, and it can go up a lot when rates go down. But his mistake that he made, which forced him to shut down his clownish ETF, was trying to play interest rates. And he got absolutely freaking wrecked. Don't F around with TLT. It's a trade. And don't freaking time your freaking buys based on TLT. Why don't you dollar cost average every paycheck? And you don't have to worry about timing the bottom because it doesn't freaking matter because you're buying as it goes down. This is not complicated. You make it complicated. Have cash. Keep your job. Make other sources of income. Continue to dollar cost average. Don't take out high interest debt or reset your low rate mortgage, which is a gift from God. Stop being stupid.
More poopy, right? Bond values are going up as yields are coming down. I would argue that something in the range of 140 to 160 probably aligns with the bottom, because that would be historically, this is.
That's it, guys. When it's 140 and 160, just buy the dip. It's rocket science. It's not even rocket. It's easy, bro. 140 to 160, just buy the dip. Good. Take out a loan, bro.
Where TLT has peaked out and it is usually the sign of complete capitulation in markets. So at this point, at this indicator point, it may make logical sense to just buy the dip on everything in the stock market. Obviously, no guarantees, but that would be a metric that I would look at. So there you have it.
So what if you're waiting for 140? It's 125, and you're like, well, Meat Thruster said it's 140 to 160, so I'm going to buy when it's 140. And then it never gets to 140, and the stock market recovers. And then all of a sudden, you're sitting there with cash like a moron, or you're paying interest on a HELOC, which he told you to get, and then you panic buy after the market's up 20%. Stop! Stop!
10 ways to protect your wealth during the next downturn. Thanks for watching.
Okay. So what do you guys think? Whose advice is better? King Kong, the little clown with the small YouTube channel, or and before we get to comments, why don't you book a free 30-minute tax consultation with me? I am a certified public accountant. I will do your business and or personal taxes any state in the United States. You can talk to me for free. I give you upfront quotes, and I'll prepare your taxes like a boss. Click the comment, book a consultation. Free. How much for your course, bro? 10K? Okay, take my money, 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 money. But nobody wants Strongman's statement of cash flows seminar. Okay? Nobody wants that. $50. But Meat Thruster, 10K. Oh, take my money. Take my money. Morons. Oh, it's coming. Don't worry. Access more capital to put into cloud stocks that you will lose money on. Absolutely. Buy the dip on AMC when it goes to 1 cent. Oh, God. We DCA through this. There you go. You DCA. It's not freaking hard. I don't understand. I will never understand the mentality of timing, trying to time the bottom and the top. I don't understand it. If your investment horizon is long enough, it doesn't matter. Yes, it does. My stocks are going down. It's red. This clown was saying to buy the dip at the start of the best market at the end of 2021. Most of these stock picks of clown stocks never came back, like Tattooed Chef. Tattooed Chef, what's that? That never happened. Who bought that stock? These guys are morons, okay? I mean, I'm not perfect either, but I think the general strategy of DCAing into a tax advantage account and not looking at the market and thinking of the long term, it works. Okay? You're not going to get your little vertical lines and your year-to-date returns, even though your total returns are garbage. But in general, it'll work for you. Okay? Oh, God. I feel like that is just saving pennies. Gambling dude, there is no way in heck I would ever refinance this mortgage. 2.89%? $1,056 a month? It's a gift from God. I couldn't have had a better mortgage. I'm never refinancing this. I'm staying here forever. And in 10 years, when my income's double, probably with inflation, my mortgage is going to be nothing. It's going to be like a car payment, basically. There you go. Why is he wearing It's RuneScape. Wow. Meets Kevin wants you to risk that. Oh, I'll risk it all. Let's see. Oh, my God. Oh, well, see, me, Kevin doesn't have recession risk. He'll just pump out more videos, and actually people will watch it. Oh my God, what do I do? And he'll tell you, he'll feed you the poison, and you'll buy his course, and you'll listen to him because you're a bunch of clowns. That's how it freaking works. Just 1031 exchange, bro. Never pay tax, bro. It's so easy, bro. Or just don't do real estate, my opinions. So many comments. Oh, we got a super chat. I don't care what anybody says about S&P and NASDAQ. Show a depression between 2000 and 2012. American industry was already gutted before 2008. Just buy VT, man. That's right, people. This is not complicated. I think investing is the easiest thing. I think personal finance is the easiest thing in the freaking world. Spend less than you make and dollar cost average into your chosen index and never sell it until you need it in retirement. It's not hard. But TLT and interest rates and Ross Gerber. This is so cringe. He's writing on a whiteboard, though, so I need a whiteboard. Then people start listening to me. I'll trust a shirtless man more than the man wearing it. That's right. You better trust me. Give me all your money. Hi, Dibba Warrior Unite. Let's see. All right, we got Gil in the comments here. He's raving and ranting about capital mindset. All right, guys, what do you think? Do you think me, Kevin, gave some good advice there? I mean, he said some things like, I don't know, don't spend a lot of money on capital expenditures. Okay, I get it. Yeah, that's fine. And then he talks about HELOCs and freaking negative points. What is this nonsense? No, just stop, people. Okay? Anyway, like, subscribe, click the pinned comment, book a free 30-minute tax consultation with me. I am a certified public accountant, business or personal taxes, any state in the United States. You can talk to me for free. I'll give you upfront quotes, and I will do your taxes. I've been filing taxes today, baby. I've been hitting EF, transmit, sending those taxes to the IRS in the States. Oh, it's been a good, productive day today, baby. Talk to you later. Cheers.